You're listening to Mortgage 101 with Clinton Wilkins and myself, Dan Allstrand.
On today's episode, we welcome special guest co-host Dan Allstrand to the show.
And it's Financial Literacy Month. We'll talk about why it's important and why we take it so seriously here at Mortgage 101.
To kick things off, we're talking about the ins and outs of credit.
How are you?
I'm doing great. Thanks for coming down.
Wild.
I appreciate you coming in. Obviously, Todd's not with us this time, but I think he's going to be back soon.
Well, we might have some good news about that shortly.
Okay, well, we'll stay tuned.
He did send me a note saying, don't screw up too bad, Dan.
I think it's going to be all good. I think it's going to be all good. And November's just so important. It's Financial Literacy Month. For us, it's one of the most important months of the year. And really, this show, it's all about education. And, we're going to talk about, I think, some really great topics. We're going to talk about income, we're going to talk about assets, and we're going to talk about credit. And we have some great guests joining us as well. So I think it's going to be great.
I'm looking forward to it.
Yeah,
because
me too.
Every time you and I speak, I always learn something, and I know our listeners always learn something, and I know that the people that listen to Mortgage 101 learn something. So it's helpful that it's the Literacy Month, and we are going to hopefully educate a few people. I guess let's set the table and explain why having an entire month dedicated to financial literacy is so important for Canadians.
You know what? I think we need to break it down for people. And I think sometimes people just put their head in the sand, and I've used the word ostrich before, and they avoid learning or knowing anything about personal finance and finances really in general. But it's the biggest part of people's lives. When there's so many things that it can be, impacting. Your credit can impact you getting a job, or even renting an apartment, or obviously getting a mortgage. That's very, very important. But, we're talking about things like building assets. And as you know, Canadians that are homeowners are typically building assets a lot quicker. And there was actually a report out just recently that homeowners have just such a huge advantage over renters in terms of building net worth. So we're going to talk obviously a little bit more about that. And we're going to talk more about income. More and more Canadians, they're becoming self-employed every day, and that can really be daunting. And I've seen clients that have gone from being employed to then being self-employed, and they really just fall on their face. So we'll talk all about these good topics, and we're going to bring it all together on how does it impact home ownership and obviously mortgage lending. And we're going to just put a nice little bow on it.
I talk to a lot of parents, Clinton, and they tell me that, the education system does a good job of teaching their kids, the basics, the reading, the writing, the arithmetic, but the nuances of day-to-day living maybe gets missed a little bit. And I think that's why Financial Literacy Month and the stuff that you do during Financial Literacy Month is so important, because it gives parents and maybe soon-to-be parents some extra tools to be able to function. Because when you get out of your parents' house and you're in your first apartment, that's a big open world that you know nothing about, right?
It can be very scary for people when you even think about just the basics of even writing a check. That's not really taught in school anymore. Probably like what we did when we were growing up. You learned how to balance your checkbook. They don't teach this. They really should be teaching about, what is credit? How do you build credit? How do you maintain credit? What are the 5 C's of credit, for example? And they don't. But I think overarching, there's such a taboo of talking about your own personal finances or talking about the finances at the dinner table. And I hope that by us doing this show, it's going to break down some of these barriers. And I hope that parents will have conversations with their kids. And I hope that people will start having conversations with their spouses. It would shock you, Dan. People kind of operate as independent operators, even though they may be married or in a relationship. They're not talking to their other spouse about what's going on with their income, assets, or credit. It's just so important.
And some relationships, they keep everything separate, like the two people in a relationship.
And that might work.
And it might, but
there can be downsides.
And they don't tell you about it.
No,
right?
Exactly.
And then you don't know what's going on, and that's when we hear the horror stories.
Well, I certainly get the people into my office, and we try to sort that out. But sometimes we just have to have very frank and open, honest conversations with people. And really, that's our goal. Let's break down some of the barriers. Let's have the conversation at the dinner table tonight. Let's talk to our kids about, what credit looks like. And, even talk to them about building credit. Sometimes having no credit is as bad as having bad credit.
And that was my next question. You hear a lot of horror stories with credit cards and people overdrawn and late payments and collections and all of that bad stuff. But credit can be a useful tool, can it not?
It certainly can be. I think even just having credit that you're monitoring, I think is important. There's a couple free tools out there, and we've mentioned it before, but there's Borrowell and Credit Karma that customers can download from their app store and monitor their credit. And it will give them kind of gamified solutions on how to better build their credit. Yes, they're going to try to sell you some stuff. I mean, nothing comes for free in this life. But I think just building it up is so important. A lot of employers will check consumers' credit before they hire them. That is a risk indicator. When you go to get car insurance or home insurance, they can do a soft inquiry on the credit bureau, and they're going to see what's on your credit. Obviously, getting a mortgage, we're doing a hard inquiry. We're really digging deep into what does the history look like? What does the utilization look like? What does the credit mix look like? And we look at a lot of other indicators on the credit bureau. We look at, names. We look at date of births. We look at, obviously, the SIN number. We look at inquiries. We're really digging deep into that credit bureau to really give the best credit analysis when we submit a file to a lender that then, if it's going to be a high ratio transaction, then go to a mortgage insurer as well. We're not just spraying and praying here and hoping for the best and throwing things at the wall. We're really doing a deep analysis on what does that credit look like, especially in a mortgage transaction.
This might be inside baseball, but when somebody comes to you and wants to get a mortgage and you do the credit check on them, what are you looking for? Are you looking for a history of using credit and using it effectively? Or are you looking to see how much credit they have, how many credit cards they have, or is it a combination of everything?
I think it's everything and it's more, Dan, to be honest. We really look at, what is the breadth and the depths of the credit. It's not just how are the payments made. What is the mix? What is the utilization? You can have, in theory, really great credit. You're paying all your bills, but the score can be very low. And that can be really driven down by utilization. So, for example, let's say you have a $5,000 limit on your credit card. If your balance is at $5,000, that's not good. You never really want to go above about 35% of the credit limit. So, obviously, utilization is very important. Payment history is very important. And really that mix of credit. If you only have credit cards, probably not going to be the best. If you only have loans, not going to be the best. You want to have a mix of the credit, but you want to have significant credit. Having a $500 credit card, probably not going to do the best for you in terms of building credit. We want to see significant credit facilities. And the best credit facilities really come from, bank style lenders. There are some subprime lenders that obviously report to the credit bureau. Things like maybe, in theory, like the old school, like Wells Fargo, City Financial, or maybe in today's world, Easy Financial. These are creditors that, yes, can potentially help you build your credit, but we don't think of that as a prime credit. Like that's someone that can get, credit anywhere will typically be given those type of facilities. It's also the mix. If you have a car loan and a credit card, that's a pretty good mix. We want to see that you have at least 2 or 3 open facilities, and they need to be significant. Like we're talking $2,000 plus. And I think that's really the way to build some good credit. But if the credit's not good, Dan, it doesn't necessarily mean that you can never transact. Obviously, we have solutions for people, maybe if their credit's not the best, or if it's being established or they need our help to get it reestablished. We have solutions for those people. But I always say that you can have good credit in 6 years. It doesn't matter if you messed up today. In 6 years, your credit can be repaired. Because in Nova Scotia, any of these bad things, they fall off. They're going to fall off your Equifax, and they're going to fall off your TransUnion credit bureau 6 years after the date of the last activity. So, if you've had any challenges in the past, just make sure it's going to be good going forward. But I see so many people missing just a small payment. Sometimes it's a cell phone. Sometimes it's a student loan. And that can sometimes really hold them back. Like if you have very thin credit and you're missing payments on your cell phone, that can kill a whole transaction. And with cell phones, oftentimes they'll take an automatic payment, get that set up to come off your credit card automatically. There's lots of solutions to automate your life that's going to make things much better for you.
We all have seen the commercials. Mm-hmm. How important is that number, that credit score number?
It's not everything. It certainly is. It is something. Obviously, the stronger the score, kind of the easier it is for us. If we're seeing scores in the 800 plus, you have excellent credit. between 700 and 800, it's usually good. It can be, can be great, but maybe it's not great right now. Anytime it's really under 700, we're digging more deep into the credit, to be honest. We're looking at utilization. We're looking at payment history. And I'm not saying we don't look at it when the scores are high. We still do. But we're really going to do a deep dive more into the credit the lower the score goes and just figure out what is the issue, what's bringing that score down. And sometimes we can just coach clients to increase it. And sometimes they can increase it in 2 or 3 months. It's that easy. Sometimes, obviously, it takes 6 years or somewhere in between. But there's always a way to improve it and figure out what the best solution is.
If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.